Hello and welcome to the Beginner's Guide to Forex Trading. So this video is specifically designed for beginners. If you're not a beginner, head away now, it's not going to benefit you. But if you are a beginner and you're new to this or relatively new to this is going to set you up with everything you need to start moving forward actionably and profitably and successfully with your trading journey. Okay, so if you've got absolutely no knowledge, this is how you set up and this is what you should expect from trading and what you need to do next. So just to commit you to watching the video, why should you listen to me and who am I? Well, I have 6.5 years of experience in trading. I have 3 years in teaching. I have $1.2 million in trading capital. I've helped my students to acquire over $13.5 million in funding in the past 1.5 years and over $3.3 million in actual real profits in the pockets and in the bank account of people that I have taught to trade. So if you listen to me and you listen to everything I say and you do what I say, you're going to do just fine, okay? So in this video, I'm going to show you what Forex is, how it works, who trades Forex and how money is made, different styles of trading, the setup and the different softwares and platforms you're going to need. And then I'm going to talk about trading plans and building out a trading strategy. Then I will give you an actionable plan to move forward with, okay? So the goal of today's video is to take you from a total beginner to a knowledgeable trader with a blueprint to move towards success with. Without further ado, let's get into it. So the first thing I want to talk about is what Forex actually is. Forex is the foreign exchange market, hence the name Forex. It's just an abbreviation of foreign exchange. Now, the Forex market is a global market where the values of currencies are traded against one another. It's the largest financial market in the world, and actually $7 trillion on average passes hands every single day that the market is open. So there's massive opportunity, and there's a considerable amount more money flowing through Forex than there is through any other financial market. So who trades Forex then? Well, there are two major types of market participant that you should be aware of, because if you are aware of these, you will be able to use this when you are building your trading plan. There are retail traders, which are normal people, just like me, just like you, who are trading at home or from whatever, okay? Then we have institutional. Institutional participants are banks, funds, investment funds, hedge funds, whatever, big trading firms, basically any regulated entity with a large pool of money, okay? Institutional does trade Forex as well, and maybe you'd be surprised to hear that banks and institutions actually make up for over 90% of the money flow through Forex markets. So even though there's probably hundreds of thousands or millions of traders around the world in the retail sector, we are only responsible for around 5% of the actual money flow through the market, which is actually quite important when it comes to building trading strategies. And we'll talk about that a little bit more in a bit. So inside of the Forex market, we know we are trading foreign exchange, okay? We are trading the value of currencies. So what we actually physically trade is called a currency pair. It's basically an asset or a contract comparing the value of two currencies against one another. So currency pairs look like this down the bottom: Euro USD, USD JPY, AUD CHF. Now, for you to understand what that actually means, because at the moment you probably don't know, here is a little bit more depth on currency pairs. So this one here, EUR USD, this is the value of the euro versus the value of the US dollar. So that means if we wanted to trade the value of the euro versus the US dollar, we would either buy or sell Euro USD. We'll get to that in just one moment. So currency pairs are made up of two currencies, obviously, because we're trading the value of two currencies. But we have a base currency and a quote currency. So the base currency is always the currency at the start of the quote. Okay, so EUR USD, that means that EUR is going to be the base currency. In this past example, AUD CHF, AUD would be the base currency, CHF would be the quote currency, and USD JPY, USD is the base, JPY is the quote, okay? Now, when we are looking at base versus quote currencies, base currency is always equal to 1. The quote currency, however, is the equivalent value of 1 unit of base currency. So that might sound confusing now, but it's all good. I'm going to explain that. So if we're looking at EUR USD, the euro versus the US dollar, with EUR being the base currency, that means that we are looking at the value of 1 euro, okay, so 1 EUR, versus the equivalent value in US dollars. So if the value of Euro USD is 1.09489, as you can see in that screenshot there, that means that 1 euro is equal to 1.09489 US dollars, okay? So it's basically always going to be 1 unit of whatever currency is on the left, then followed by the equivalent value of the currency on the right. Now, in Forex markets, we can trade every single global currency. However, they are split into different categories, and not every currency pair is going to be equal. There are major pairs, minor pairs, and exotic pairs. In my opinion, and well, general market fact, majors do have the best trading conditions. So when I show you the major pairs in a moment, I would suggest you actually stick to trading these as opposed to trying to trade the minors, the crosses, the exotics. So major currency pairs always include the US dollar. Now, you probably don't know this if you're new to the world of Forex, but the US dollar is the world reserve currency. That means that all of the world's trade and transactions, or the majority of it, happens in US dollars. This means the US dollar is not only important in the United States, but it's important around the entire world. And it actually becomes essentially the most important currency in the world. So the major currency pairs always include the US dollar. So here is a list of all of the major pairs. We have the euro versus the US dollar, which is EUR/USD. The Great British Pound versus the US dollar, which is GBP/USD. The US dollar versus the Canadian dollar, and that is USD/CAD. United States dollar versus the Japanese yen, which is USD/JPY. The US dollar versus the Swiss franc, which is USD/CHF. AUD/USD is the Australian dollar versus US dollar, and NZD/USD is the New Zealand dollar versus the US dollar. Don't worry, I'm not going to keep rambling on about every single currency pair in existence, but these ones are very important to understand. So just to kind of get in mind the previous point about base currencies and quote currencies as well, the base currency is always going to be the one on the left, and the quote currency is always going to be on the one on the right, okay? So if we're looking at USD/CAD, we're looking at the value of $1 and the equivalent value in Canadian dollars. All right, so moving on to the minors. Now, minors can also be known as crosses. So minor currency pairs are crosses of any of the major global currencies without the US dollar in them, okay? So we're looking at things like CAD/JPY. So we're looking at the Canadian dollar, the Japanese yen, both incredibly important global currencies, but with the absence of the US dollar in the currency pair. Euro/GBP is another example. That's the euro versus the Great British Pound. And then also things like the New Zealand dollar versus the Swiss franc, okay? And then we have exotic currency pairs. Now these, I would personally say, just totally avoid them. I've tried trading them in the past. There's no point really. So exotic currency pairs are currency pairs made up of one major global currency and one emerging markets currency. So some examples would be the Mexican peso. That's an emerging markets currency. The South African rand. We have absolutely loads of these emerging market currencies. They give very erratic price moves though, and it actually makes it hard to consistently make money on these. So I would just say, stick to the majors. As I've said before, it's going to be the best way and the fastest and most effective way for you to get to success. But those are the three different types of currency pairs. We have the majors, the minors or the crosses, and the exotics. So how is money actually made by trading these currency pairs then? Well, in Forex, money is made by correctly betting on the direction of a currency valuation change, okay? So as an example, to simplify things, if we think the euro is going to go up against the US dollar, we buy EUR/USD, okay? If we're right, we can then sell that contract at a later date for a profit. If we're wrong, we will have to close that contract, sell that contract to someone else for a loss, okay? Now, we are buying and selling contracts, but it's all absolutely automated. It's not like you have to go and physically sell something to someone. You simply click a button and the contract is bought or sold. Now, when we are trading, we are always looking to achieve a positive outcome in pips, okay? Now, don't be fooled, pips are less important than you may think, and I will talk about that on the next slide, I believe. But right now, just so you understand what pips are, this is how we measure price movements. So when we look at a currency quote, here we have GBP/USD. That is the Great British Pound versus the US dollar. GBP being on the left is the base currency. USD being on the right is the quote currency. So £1 is equal to 1.26956 US dollars. Okay. So when we are looking at the 1.26956, to measure pips, what we want to do is always chop the number off at the right. So that small number in red, the 6, we can chop that off. That is a point of a pip. So think about millimeters to centimeters, okay? So chop that off, move one step to the left, and that is 1 pip. So if we went up from 1.2695 to 1.2696, the value of that currency would have gone up by 1 pip. If we went up from 1.2695 to 1.2705, that would actually be a 10 pip increase. If we went up to 1.2795, that would be a 100 pip jump. And if we made a jump from 1.2695 to 1.3695, that would actually be a 1,000 pip increase in the valuation. Now, you're not going to see that often because that takes a lot of time. But that is how we measure the changes in price moves, okay? Pips. So leading on from what I said just before we started talking about that, pips are a lot less important than you may think. There is actually a better way to track your profits and losses, and that is in percentage terms and risk versus reward terms. We're going to discuss those later, so don't worry if they're a bit confusing now. Okay, so now let's quickly talk about some different ways to trade. Now, when we are trading Forex, we never actually buy a physical asset. It's not like you're going to a bullion vault and buying an actual bar of gold. It's not like you're going to a currency exchange and actually buying a bunch of euro notes. Instead, what we are doing is essentially buying a contract. We're essentially betting whether a currency is going to go up or down by purchasing a contract on a currency pair. What's good about this is it actually gives us the flexibility to trade long, or short. So these are the terms for the different trading types. Long is a buy. So if we long a market, if we go long, that means we are buying a currency pair. So let's say we long Euro USD. If we long Euro USD or buy Euro USD, we will profit if Euro USD goes up, and we will lose if Euro USD goes down. Okay. So generally you want to buy low, sell high. You've probably heard that before, but we can also sell high to buy low. So we can actually sell before we've even bought. And that's what we call a short position. This is basically a contract where we bet on a decline. So what we do here is we actually enter into the market with a short order, and basically we flip it in reverse. So we sell before we buy, but then we are locked in to have to buy back at a later date. So if we short the market and the market falls, we will make money. But if we short the market and the market goes up, we are going to have to reclaim that contract, and we're going to have to buy that contract back at a later date for more expensive than we sold it for. Okay, but it's cool because we get double the opportunity. We can buy and we can sell. So unlike stocks and other markets where you are buying a physical asset, we can actually profit from when the market falls as well as when the market goes up. So it doubles the opportunities for us. It's pretty cool. So that is the basics of Forex. I've showed you what it is, who trades it, how we trade it, what the actual assets are, and how we make money doing that. So now what I'm going to do before we move on to talking about trading strategies is show you the setup. So in order to actually place trades, you are going to need a few things. First of all is a brokerage account. Second of all is a trading platform. Third of all is a chart software. Without these, you can't analyze markets and you can't even place trades. If you can't place trades, you can't make money. Simple as that. So here are my recommendations for some of these setups. First of all, starting with brokers. Now, a broker is actually the person or the company that will facilitate your entry and exit into trades. Absolutely essential. With no broker, you cannot trade. Okay. Some brokers are really good. Some brokers are really bad. So make sure you pick a good one because you don't want them to steal your money. Now, I will give you my 2 picks. I like IC Markets. I like Vantage Markets. Feel free to do your own research. If you're in the United States, I'm not sure if you'll be able to trade with these different regulations and such. Also, if you're somewhere like India, you might not be able to. But if you look around, you'll be able to find one that's good. But my picks, if you can, IC Markets, Vantage Markets, super good. So once you have a broker account, you need to go over to a website of a broker. IC Markets and Vantage Markets are good. If you head to one of their websites and make an account, you'll then have an account with the broker. Then you need a trading platform. So the main trading platforms you want to look into for trading Forex are going to be MetaTrader 5, MetaTrader 4, or CTrader. I personally like MetaTrader 5 the best. Super simple, very, very simplified platform. Works fine just for executing the trades. All we need, okay? So I would go with that. Now the concept then is when you have a trading platform, you log into your brokerage account inside of the trading platform. So you can't trade with one or the other. You have to have both, okay? This is the platform where trades are actually taken. But the broker is the person who will actually facilitate the trades, get you into your positions, get you out of your positions, and allow you to actually risk money to make money. So once you finish this video, you need to go and make a broker account, and you also need to make a MetaTrader or CTrader account with either MetaTrader 5, MetaTrader 4, or CTrader, and then you need to log into your brokerage account inside of the trading platform. Now, when it comes to chart software, if you don't know what charts are, that's fine. We'll talk about it in a bit. It's what comes down to technical analysis. I would just say straight away, unrivaled champion of chart software is going to be TradingView. Don't even bother going anywhere else. TradingView's got everything you need. They have free plans, paid plans, just brilliant. So after you've got your broker account and your trading account set up, get yourself a subscription, whether it's free or paid, to TradingView. All right, so just before you do go and do that setup, when you are setting up your brokerage account, you'll have the option to trade demo or live. Choose demo, okay? Do not choose a live account. Do not put real money in a live account. 100% guaranteed you will lose that money. If you decide to ignore me and think you're smarter, just know I'm laughing at you from above when you lose all your money, okay? Trust me, just don't do it. Don't throw your money away. Lose fake money first, not real. So choose a demo account. This is going to allow you to basically try everything out, test out strategies, give trading a go for the first time ever, and all the money's just fake. It's like a video game. If you lose it, you just reset the account. Do this. This is the best way you can start out. Trust me, please, I lost so much money by not doing this, so just choose a demo account. Okay, so that is the setup. We need a broker account, a trading account on a trading platform like MetaTrader, and we also need a chart software, somewhere we can actually analyze markets and find trades. So now let's talk about building a market edge. This is a very important topic. Without a market edge, you can't make money, okay? So what is a market edge? Well, in its simplest form, trading is basically calculated gambling, okay? The reason I say this is because we win trades and we lose trades, just like a calculated gambler would win and lose, okay? We can never win every single trade we take. There is an element of that gambling to it. It's a probabilities-based game. We are going to win trades all the time. We're going to lose trades all the time. And we need to have a market edge in order to actually make money long-term. A casino always has an edge in blackjack. I think it's a very small 1, 2, maybe even 3, 4% edge. but it means that they are going to lose money to some gamblers. They're going to win money from some, but overall they know, because they have that percentage edge, they are going to win after enough hands are played. Okay, so after enough people come into the casino and play, even if the casino loses a few $1,000s today, they're going to make it back plus more tomorrow, and so on. So we need an edge in the same way that a casino has an edge over the gamblers, or in the way that a poker player may have an edge over other poker players. Our market edge is going to be crafted through multiple avenues. We need to consider fundamental analysis, technical analysis, risk management, the sessions and timing we'll be trading, the routines and schedules that we will be trading to, and backtesting and journalings. So these things will be crafted into a trading plan. And that is basically our working business plan to then go and trade with to actually make profits in the market. So what I'm going to do is go through each of these things now. I'm not going to go through the last few, but I will point you towards some YouTube videos that I've made about these topics. So fundamental analysis, what is this? Well, fundamental analysis is the process of using real world economics to determine trend directions. Most people don't use them. If you've been looking at other videos, you've probably not seen anyone talk about fundamentals. People are just showing you chart strategies and things like this. So most people don't use them, but also important to remember, trading has around a 2 to 5% success rate. So most people don't use them, most people lose, okay? Don't be fooled, and don't underestimate the importance of actually bringing economics into your work. Fundamental analysis uses economic data and economy-based politics and government actions to work out which currencies are strong and which are weak. So what we're doing with fundamental analysis is basically going to the source. If we're trying to work out which currency is going to do better than the other, what better way to do that than to go and look at the governments of those currencies and see what actions they're taking? We can work out from there which currency is going to do better than another, okay? So fundamental analysis, awesome. So technical analysis is the chart work. So you've seen the charts, you've seen people trading charts probably if you've even glimpsed at Forex. Analyze and trade ideas using price charts is actually what we do here. So we can use these charts to kind of work out where we're going to get into trades, where we're going to get out of trades. This is a core piece of your trading strategy, but it is not everything. So as a beginner, I want you to understand that trading on charts is not going to get you to success. It's everything else alongside that will actually take you to where you want to be. So to put that briefly, the importance of charts is over exaggerated. Yes, it's important. Yes, you need a market edge, but you do need to make sure you're considering everything else as well. I'm telling you this now because most traders don't. They just go straight to technicals, focus on technicals, lose forever, get sad, quit. Okay? Don't do that. So my advice when it comes to technical analysis is going to be to avoid basic retail strategies. Now, you can actually adopt whatever strategy you want. That is fine. But I would say just from the get-go, support and resistance, break and retest, chart patterns, head and shoulders, trend lines, forget it all. Moving averages, RSI strategies, don't do it. Bollinger Bands, don't do it. Okay, all of this basic retail education, it sucks. Okay, it can be made to work, but it is not the best. So I would avoid all that if I were you. I would focus more so on logic-based concepts. I'll give you a quick, brief explanation of what logic-based concepts are. These are going to be things like supply and demand. Remember these words, okay? Remember these words and study these words. Supply and demand, market efficiency, market structure, and key levels, okay? These logic-based concepts are going to be much, much better for you on the chart. I will teach you more about them over on my YouTube channel and in some of my free trainings as well. I would focus on these concepts, okay? Macroeconomics, obviously really good as well, as that's the fundamental analysis side of things. So it's just another name for fundamentals. And these are essentially real strategies. They're not just BS, random lines on a chart. They actually make sense from a logic-based perspective. So I would focus on logic-based concepts when it comes to technicals, and I would also focus on fundamental analysis, as most people don't. Trend lines, chart patterns, support and resistance, we don't want that. Supply and demand, market structure, market efficiency, we do want that, all right? Now, as my goal with this video is to set you up with the essentials and an actionable blueprint from a kind of larger picture, I'm not going to be teaching you direct trading strategies inside of this video. So please don't run away to try and learn your first trading strategy, because if you don't understand anything I'm telling you in this video, you're not going to win anyway. So if you just watch this video, take on the teachings, after that you can go to my channel and learn more about the technical side of things. Right, so now let's move on to the next topic. Inarguably, one of the most important things is risk management in trading, and this is essential to the creation of your market edge. Remember before when we first started talking about market edge, I said we're not going to win every single trade, and we will continually lose trades along our trading journey, every week or every month. For this reason, it's important that we have a process in place that will allow us to minimize risk and maximize profits. Traders will always lose trades. We can't win all the time, so we have to make sure that the losses we do take are controlled. Now, there are two primary ways that we can develop an edge around risk control. We can go for a risk-reward edge or a probability edge. So just a quick quote from a very, very famous, very successful trader, Peter Lynch. In this business, if you're good, you're right 6 times out of 10. You're never going to be right 9 times out of 10. Okay, important to understand. So now moving on to the risk versus reward edge. This is my favored way to manage risk. This is what I do inside of my systems. This is what I teach people to do. This is what works best for me, in my opinion, and will work best for you, most likely. So risk versus reward is a process where we aim to make more on the winning trades than we lose on our losing trades. This means we can be wrong on trades often and still stay on top. Okay, this actually means we only have to be right 3, 4, 5 times out of 10 to make money. This is the best approach in my opinion, and an example of a risk versus reward edge is we risk $100 on every trade we take. In return, we are aiming to make $300 or more on every trade that wins. This means we can actually be wrong 60% of the time or more and still make money, okay? So if we only have to win 4 out of 10 trades and we can still make money, a lot of the stress is alleviated from us, and that is why I prefer risk reward edge. An example of the risk versus reward edge, if you have a 50% win rate, meaning you win 5 trades, you lose 5 trades every time you take 10 trades. If you are trading with 2R, and basically an R multiple is how much you're looking to gain. So 2R means for every $100 you risk, you're looking to gain $200. 5R means for every $100 you risk, you're looking to make $500. And 10R means for every $100 you risk, you're looking to make $1,000. So looking at the different outcomes, if we trade with positive risk reward, so anything above 1R, we only have to be right 50% of the time and we can make money. After around 7 trades there, if you aim to make $200 for every 100 you risk, you'll be up around 5%. You'll be up 17% if you can make $500 for every $100 you risk, and you'd be up 37% if you can make $1,000 for every $100 you risk, and that is only if you are right 50% of the time, okay? So it's a really good way to trade. It takes away the stress of losing trades. We never know the outcome of one individual trade, which is why I like the risk versus reward process so much. Now, the other way you can trade is the probability edge. So as we know, we are working with probabilities. What you want to do here is not maximize how much you make on winning trades, but actually maximize how many trades you win. That is the goal. So an example would be you risk $100 per trade. Your aim is to make $100 per trade, but your aim is then to win more than 50% of the trades you take. Okay, so if you win 5 out of every 10 trades, you'll be break even. You'll make no profits. However, if you can win 6, 7, 8, or 9 trades out of 10, you will make profits. The reason I don't like this as much as risk reward at all, and the reason I would never trade in this way, is because it's a constant chase, and it is essentially, in a sense, gambling, because we never know the outcome of one single trade. So if we don't know the outcome of one trade, it makes sense to make as much as we can on our winners so we can flow naturally through the inevitable process of wins and losses without having to worry about winning 6, 7, 8, or 9 trades out of 10, okay? So when we are trading with a probability edge, we don't really know if the next trade is going to win. And if it doesn't, we can very quickly go into the red. So I highly prefer risk versus reward, but it's up to you which one of these you want to adopt. Whichever edge you opt to learn and adopt, you need risk control, okay? Stop loss orders and position sizing are what we use to actually build this risk versus reward or this probabilities-based edge. So a position size is just the size of the trade you open. How big is the contract that you're going to buy? A stop loss is an order that closes a trade automatically if it goes wrong. So if we buy at one level, how do we know that we're going to close the trade when we hit a $100 loss? Okay, well, we're going to do that by actually setting a stop loss. So we put a stop loss in place, and when the market goes against us, we'll be stopped out of the trade. It will close us for minus $100, for example, and we won't take a loss bigger than that. So this is how we control risk. We cut the losses as small as we can. Then we try and get the winners to run as far as we can take them realistically, okay? Now, it's crucial to have the correct position sizing and to have a stop loss in place on every single trade. If you don't, you'll have absolutely no control over how much you're risking on each position. That gets out of hand very quickly and will lead you to lose a lot, probably all of your money pretty quick. It makes it impossible to maintain the edge. And remember, guys, the only way we can win is by having that edge over the market. So when it comes to the position sizing, how exactly do we know how big our position size should be? Do we need some secret formula? Well, no, we don't, okay? I would say a good amount of risk per trade is going to be between 0.5% and 1% of your account balance. So if you've got $100, you should be risking 50 cents, $1. If you've got $100,000, you can risk $500 or $1,000. That's going to make sure you're good even if you hit a few losses in a row. It's not going to take you down too much. You don't want to be risking 5%, 10% per trade. You'll obliterate your account very quickly, okay? So in order to maintain this risk of 0.5% to 1%, we need to make sure the trades we're opening are actually the right size. So we're going to do this using a position size calculator. There's no need to learn fancy formulas. You can just use a calculator. It's pretty much cheating, but it works brilliantly. And there's enough confusion in trading as it is. We don't need to add more in by working out formulas. So this is the one I recommend. Save that link, go to that afterwards. I'll put a link in the description to that as well. Check that one out. That will be all you need to actually make sure your position sizing is correct. Okay, so that brings us to the end of building our trading plan and the different concepts we need to include in Market Edge. Fundamental analysis, technical analysis, and risk management are the components that your edge is made up of. Other important things to consider are backtesting, journaling, and mindset. Mindset plays a very big part in trading. There will be links in the description to videos on my page on these topics. I'm not going to talk about them now. We're going to continue flowing with the process. So one of the last things I want to talk about is your expectations for trading. Okay, most traders, maybe you as well, have come to trading with twisted expectations. You think you're going to turn $100 into $100,000 in a year, and you think it's going to be easy, and very soon you'll be a millionaire. You're already looking for your Lamborghini. You're already shopping for your mansion and your Rolex. You've got it all pre-saved on your wish list. Well, trading is not like that. Although you might have given into lifestyle marketing, Lamborghinis, and promises of easy profit, this is not what trading is like. This is actually all BS. Real trading is actually quite hard to master and can take years if you don't have the right guidance. Real winners are going to be making a modest 4 to 6% a month average, not 100% a week, not 20% a week, not 1% a day, as you may have heard if you've actually looked at anything else previously. Real trading is slow, steady, consistent, compounded growth, and that is what you want to aim for. And don't get me wrong, you can make a hell of a lot of money doing this. I make 5 figures a month doing this, and I've actually taught people who've been through my courses and programs who have gone on to make $50,000 in a single week, $20,000 in a week. Someone had $22,000 a day, $43,000 a day. So you can make serious amounts of money trading. Don't worry about that. But the better way to do it, and really the only way to do it, is to follow this real approach, as opposed to trying to flip your small account, risking it all, because that is going to go wrong, going to build bad habits, lose all your money, waste loads of time. Okay. So real trading is slow, steady, consistent, compounded growth, not flipping your peanuts amount of money into millions. All right. As well as wasting years on bad expectations, you'll also lose a lot of money if you ignore my lessons. Trust me. So please just listen to me. Trust me on this. Follow my advice. I'm not telling you all this for fun. This is exactly what you need to do. And that leads me on to the next point. I want you to consider this before you go any further with trading at all, because trading can get expensive. It can be stressful, can take over your mindset and take over your time if you are not committed in the right areas. So I want you to think now, because this is not going to be an easy journey for you. Are you here for passion or are you here for profit? If you're just here for the lifestyle and the money, go and start a business. Okay, I can guarantee you, I have businesses as well. Businesses are less stressful and less expensive on the learning curve to actually get into. Okay, I would say that from my personal experience. Go and start a business or work out something else, or freelance for someone, learn sales, do something else if you are only here for money, because trading is a difficult game. If you're not passionate about it, you will never make it work. However, if you are passionate and you're willing to commit your time and you're willing to commit some energy to mastering this craft, then stick around, okay? It can be done. Right, so how long does success take? How long should you be expecting to take in order to reach your goals? Well, trading success is not linear. It can take 6 months, 1 year, 10 years. It can actually take any amount of time. The fastest and the cheapest way to win is to be mentored and taught by someone who is winning and has also taught other people to win. But self-teaching is possible if you don't want to go through the educational route. Now, I actually did self-teach myself, and then I've obviously gone on to teach others. I will say, though, if you are going to self-teach, just as a warning ahead of time, it actually cost me $30,000. I lost $30,000 learning for myself, basically everything I was making in my job, plus some more. Okay, so it is going to be an expensive journey. Self-teaching, although you might choose that because you don't want to spend money, I'm just telling you now, okay, it will be more expensive than just going through some education, providing you choose good education. But yeah, self-teaching is possible, but the fastest way to win, the most optimal way to win, is to just learn from somebody. That is how much it cost me to self-teach. Okay, so now you know what Forex is, who trades it, what we trade, how money is made, what a market edge is, how to build your market edge, how to manage your risk, what your expectations should be, and how long you should expect to be trading before you reach success. So you're pretty much set up with everything you need as a total beginner to kind of understand the Forex markets and understand your next steps. Now, this beginner's guide to Forex, I laid out in a way that is different to the majority of others on YouTube. Most are just going to give you the brief information. I decided to give you that information, but put it into an actionable step-by-step plan so you can now go forward from this video and make a career for yourself and make success for yourself without just being pushed onto some random BS, okay? So what should you do next? Well, you've got a few options. Option number one, head to my channel, links in the description. Start watching some videos on the topics we've spoken about. You can look at technicals, risk management, backtesting, journaling, fundamentals, all of that stuff. I do have videos of that on my YouTube channel. Now, they are kind of broad, okay? So if you're a beginner, you don't really understand how to piece all the things together, you might get a little bit confused in the process of doing that. There is going to be value in those videos for you, but if you want a more direct plan, go to option 2. That is also free, totally free. Actionable education. So there is going to be the first link in the description is going to take you through to my 1-hour class, which is the 10K blueprint, showing you how to go from $0 to $10,000 per month and beyond. Another free video, hour long. It's going to basically build upon what we've spoken about so far. It is friendly for beginners. It's going to go deeper into those logic-based concepts, fundamentals, all this different stuff. That will be useful for you. Option number 3, if you want the fastest odds of success, come join me inside the Trading Accelerator and build your success alongside my students who have achieved obviously $30 million in funding and $3.3 million in profits. But that is, for transparency, going to cost you money. So if you do want to go the free route, check out that free training. If you don't want to do the free training, go to my YouTube and learn more there. So I am wishing you the best on your trading journey. I'm going to help you scale your winning career. You don't have to pay me. There's a YouTube channel. I got hundreds of videos that's valuable. I got that free training video that's also valuable. If you follow me on my social medias as well, I will help you go the correct way. Now, I don't want you to get caught up with all of the sleazy people in the trading industry who are going to try to sell you signals, who can try to sell you terrible education, and ultimately who are going to try and sell you a dream, okay? Don't trust the hype. Don't trust the lifestyle marketing hype. Stay fine-tuned on something that you know is going to work for you. And that is it for this beginner's guide to Forex. I hope you enjoyed it. If you did, please drop a like. Let me know in the comments. If you've got any questions, also ask in the comments. Make sure you subscribe because I'm going to help you along your trading journey. And that is all from me today, guys. So thank you for watching, and I'll see you in another video.